In today's video, I'm joined by Leslie Silva, an experienced and local loan officer here in Charlotte, North Carolina. We'll be breaking down all of your key questions about financing your next home and with practical tips to help you navigate the process. Welcome or welcome back. I'm Lisha Zephyrin, your realtor who helps you with all things real estate, whether you're buying, selling, investing, and relocating, no matter where you're headed. I'm here to make sure your move is as easy as possible. We're on air, so let's jump in today's video. In the mortgage world, how's the mortgage going? Like, is it higher? Has it decreased since this past week? What have you seen?
So right now, rates are kind of holding steady. We've seen a lot of volatility in the market, but what we are anticipating is that we'll see some decline in 2025. Hopefully we do. But yeah, that right now we're just kind of holding steady. I'd say high sixes, maybe hitting the sevens a little bit.
Yeah.
That's where we're at.
Do you think we'll ever see the interest rate the same as it was during COVID, like 4% or even the lowest around 2%?
I don't know. I think we will eventually get to the fives, but will we see twos again? I think there's going to have to be something that impacts the market significantly to see rates that low again.
Yeah. From my experience, I feel like when it is around the low twos, a lot of people would think, oh, that's great, 2%. But then when it comes to like housing, the homes will go really quickly. Yeah. So I think even though the interest rate is in the high sixes, we're not in a competitive market in that sense. So I think, buy the house and then later on when we're having to refinance, if it's like in the low 6 or the low 5s, we can, refinance around that time.
Yeah, I always tell everybody, like, the perfect time to buy a home is when you're ready. If you're trying to sit here and time the market, realistically, what are you looking to see? Like, I have people tell me all the time, I'm waiting until rates drop. Okay, so what number? What number are you wanting to see? Because sometimes when you do the math, the number that you're looking to see, and you compare it to what you're seeing now, realistically, a monthly payment, the difference that they're talking about is like $150 with the interest rate that they're like, so it's not like, in my opinion, it's not something significant enough for someone to say, I'm going to hold off. Especially when we see rates that low, we're going to see so much more competition in the market. Yeah. Like what we were seeing, yeah, sure, rates were in the 2s, the 3s, but people were paying 20, 30, 40, 60K above asking. Yeah. Right? Waiving the appraisal contingencies. So
the home inspection too.
Yeah. It's like, in my opinion, if you cannot afford to buy when rates are high, you're not going to buy when they're low because you're going to be completely priced out.
I agree.
So there's pros and cons to each, but I think if you're trying to time the market, you're going to put yourself potentially in a bad spot.
Yeah, and then you're going to see yourself like, oh, it's never going to be a good time for me to buy. Yeah. And I agree with you. I don't think it's a good idea to kind of force somebody to kind of purchase. Yeah. Like in my situation, I'm not going to force anybody to buy. Yeah. Like if they're wanting to rent, and that's fine. Renting, it's fine. Yeah. It just means that you're not ready to purchase at the moment, right? And you can just save up during that time and then you'll be ready. Yep. It doesn't mean that you're going to be renting forever. You can probably rent for 2-5 years, and then maybe after the 6th year, you're ready. Yep. So, and when it comes to like payments and interest rate, is there a difference from like 6% to like 5%? Or what would be the kind of difference? Is it $50, $100?
It's going to be, I'd have to see it to be honest with you, but yes, it's going to be above $100, that interest rate difference. But to touch on a little bit of what you were saying, that is true. Like there is a lot of people that I speak to that I do think, okay, this person is not in the position to buy right now. So it's not this like you're pushing everyone, you need to be a home or you need to buy now. It's more like there's so many people that can afford to buy a home and are in the position to do so that they sit on the fence about pulling the trigger. So it's more of that, right? Yeah. Because I turn a lot of people away, so I think it's personal finances. Are you ready? Is the monthly payment comfortable for you? And you'll hear a lot of loan officers too, or agents too, right? Everybody, they'll say, what is it? Date the rate, marry the house, or you can refinance later. there's more into that, right?
Yeah.
Like you have to realize that when you are going to refinance, you have to be able to qualify for that loan again.
Yeah.
So if you were barely getting by to qualify the first time, or I don't know, you had to, let's say, claim a lot more on your taxes when you're to be able to purchase the home,
Yeah.
that's something that's going to have to apply when you go to refinance because you have to qualify again. So I think it's, yes, have that idea that if rates drop, you can refinance, but we don't know when that's going to be, and we don't know to what level rates are going to drop to. So I think there's also some, like, you do need to be comfortable with the payment that you're going into if it was to be a long-term payment.
Gotcha.
Yeah.
Gotcha. And another question that I have, or that just came to mind, what's the difference between adjustable rate mortgage and the 2-1 buy down?
Okay, so adjustable rate, they're completely different. So an adjustable rate mortgage is basically your rate varies. So your rate isn't fixed. So if rates in the market go up, and this is after you close, right? There is levels to it. So it's not like you have a 6% one day and the next you have a 20. Like it's not, there's limitations to it. But essentially your rate is not fixed. So however the market changes, your variable rate is going to vary a little bit here and there. With a 2-1, is that what you said? 2-1
yeah, 2-1 buy down. Yeah.
2-1 buy down, it's a different program. So essentially it's with seller fees, typically, seller credits, and we use that to pay a fee. So your rate is going to be 2 points lower the first year. So let's say, for example, your note rate was a 6.5. Okay, just an example. First year of your mortgage, you're going to have a 4.5. Second year of your mortgage, it's going to go up 1 point. So it's going to be a 5.5. And then by year 3, it's going to be a 6.5. So it'll keep going up, but once it gets to that note rate, the 6.5, it won't keep going up. It'll stay like that. Yeah. So one is just to keep that payment lower initially, but then it'll hit the note rate and it's a fixed rate. The other one will keep varying.
Okay, so what happens if someone already has an mortgage, right? Are they able to switch the loan to a different one, like FHA, conventional, USDA? Yeah. Is that possible?
Yeah. They can always refinance into a fixed rate mortgage. Yeah. So with the temporary rate buy down, in my opinion, the goal is to refinance before you hit the note rate.
Okay. So that's the positive side as far as the 2-1 buy down. Yeah. What's the negative side of having or getting a 2-1 buy down?
Negative side is that, let's say note rate is at 6.5 and you are not comfortable with that payment. You're only comfortable with the payment at a 4.5 or 5.5. It is going to hit that note rate of a 6.5 eventually. So that's something you do have to be cautious of, is that monthly payment will be going up. Yeah, it's temporary.
And is that the only option we're able to get as first-time home buyers, a 2-1 buy down? Or what are other options or programs that first-time buyers can qualify for?
So those temporary rate buy down programs are not exclusive to first-time home buyers, right? And you'll hear a lot about a first-time home buyer program. That's not a thing. It's a program just because you're a first-time home buyer. There's perks with being a first-time home buyer, but it's not a program exclusively because you're a first-time home buyer, right? So if you are a first-time home buyer, one of the perks or the benefits is that on a conventional loan, you can qualify for just 3% instead of 5%. So that's a perk there. There are different down payment assistance programs that you're eligible if you're a first-time home buyer.
Yeah.
But it's not just because you're a first-time home buyer, you qualify for different benefits.
Gotcha.
You know, like exclusively because you're a first-time home buyer.
Gotcha. Yeah. And you mentioned the 3% with the conventional. So many people say that you need 20%, right, for down payment.
Yeah.
Is that true or false?
False. So, well, it depends, right? So if you're buying a primary, it's going to be, again, 3 to 3.5% depending on the loan type if it's a primary residence.
Yeah.
Now, if you're buying an investment property, then it's 20%.
Okay.
So that's a big misconception. And sometimes people will believe, so another example too is, like, let's say you bought your primary, you've lived in it for a little bit, your family size grew, or you want to upgrade and you want to buy your next primary. If you're buying it as a primary residence, you can purchase that next primary with 5% down. So again, it's not 20, it's not 10, it's 5.
Okay. And who are considered first-time home buyers?
So first-time home buyer is going to be anybody that has not owned a home in the last 3 years. So if you did own a home and you sold it last month, you're not a first-time home buyer. Yeah.
What are the closing costs and fees associated with the loan? Can you kind of break it down for us?
Yep. So as far as funds to close, you're going to need your down payment.
Okay.
And then your closing costs are generally going to be between 2 to 3%. So I would say it just depends on the loan amount, but I'd say about 7 to 8K generally, just depending on the purchase price. And what's included in that is going to be any lender fees that you may have.
Okay.
Appraisal fees, inspections, credit report fees, flood certificate. Those are generally lower cost. Attorney fees as well. Taxes, insurance, and any transfer taxes.
Are there any fees of loan application or processing fee? Or what's that fee that with Grow Mortgage? What's their number, or does it vary?
Yeah, so we don't have any fees to take an application. Some lenders will charge for a credit report fee. That's becoming more and more normal. We don't charge it right now. I don't think we ever will. But that is a thing that you might come across. So if you do, it's becoming more normal in the industry. And that's it. We don't have any Grow Mortgage fees.
Interesting. Is that the only thing that kind of sets you apart with other officers, or what's other things that you guys kind of differentiate from other loan officers?
I think we have a really incredible process. Like, I think our team and the way everybody works is incredible. Our ops team is top notch. Everybody has like a very dedicated role.
Yeah. So
you know what everybody's task is, and it's like a well-oiled machine. It runs very well.
Yeah.
So I think that's a big thing about Grow Mortgage.
Okay. And the typical closing is around 45 days, right? Are you guys able to close in less than 45 days?
Yeah. So I'd say it's more about like 30 days. Sometimes we do need 45. It really just depends on the loan program, the client, and what their needs are. But I've had a lot of files that closed in 2 weeks, 21 days. So depending on the situation, we can accommodate a quick closing.
Okay. I know we're kind of jumping around with the questions, but if somebody is self-employed, right, are there any like specific programs or loan that can, qualify them? Because some of them are only using based on their W-2s or on their I-10 or on their 1099. Are there any programs specifically for those type of loans?
Yeah. So if you're self-employed, you can qualify for a normal loan like anyone that's W-2.
Yeah.
Unless if you claimed a little bit too low on your taxes, maybe you had too many write-offs, too many deductions, you can take advantage of those tax advantages, to not claim as much on your taxes. That's great. But when we go to qualify you for a mortgage, we don't look at your income before those write-offs. We look at your income after those write-offs. So if you wrote everything off, you might not be showing enough income to qualify, even if you made a lot of money.
Yeah.
Right? That's a very common issue we run into with self-employed clients. So with that, we do have bank statement loans where essentially we look at your bank statements for the last 12 months, and that's how we determine qualifying income. So that's a great program. The only thing to keep in mind is that your down payment is going to be higher. So it's going to be at least 10, most commonly 15 to 20%, just depending on your credit and your own situation, your own scenario.
Yeah.
Now with I-10, you're always going to see 15 to 20%, most regularly 20.
Yeah.
And with our I-10 program, we only need 1 year of taxes. So that's pretty unique because usually you're going to see that 2 years are required. And again, we can go the bank statement route with I-10 or what's called a profit and loss statement loan, where we just get a profit and loss statement from their tax preparer CPA.
Thank you so much for watching part 1 of our home buying Q&A. I hope you found it helpful. And if you have any questions or want more details, drop them in the comments below. Don't forget to hit the bell so you don't miss part 2, where we will cover even more tips to make your home buying journey easier. See you in the next video.